Welcome back, traders and investors. We have Ashraf Laidi on the line, Chief Global Strategist at City Index FX Solutions. How you doing this morning?
Very good, very good. It's so hard to get my name, my last name right. It is Laidi, but I'm doing very well apart from that. It's Laidi.
Okay, I should. You know what? I should have. You said that to me, and I should have just sounded it out and said it the way I wrote it down, Lighty. But sorry about that.
No
Taking a
problem.
look at the markets this morning, we did have some news last week out of the ECB, but I liked your comment before we got on the line. You're like, "That's old news. There's new stuff out there." So talk about the most recent information on the sterling pound.
Well, the big stuff, the huge stuff, is that on Saturday, while everybody was enjoying the weekend, looking at the football scores, at the soccer scores, at the U.S. Open, and the U.S. closed, this news comes out from the Sunday Times, not the New York Times, but the Sunday Times of London, and boom, what it shows that the polls, the expectations for the September 18th referendum on Scotland, the question on the referendum is, will Scotland go independent, or do you want Scotland to go independent? For the very first time, the yes showed, I believe it was 52%. It was a majority. For the first time, it showed that it was a majority for the yes referendum. Something unexpected, because for the last 3 or 4 weeks, all the polls have been showing a no, meaning Scotland stays. Now that the markets are getting closer to September 18th, this is causing uncertainty, not only because Scotland wants to leave the UK, it wants to keep the pound, but what it would mean, it would mean that the new United Kingdom, which is Ireland, Wales, England, minus Scotland, will not have the Scottish oil, and what was expected to be a rate hike by the Bank of England in probably 7-8 months' time may no longer be the case, because there's going to be that energy revenue strength from Scotland that will be taken away in case they do go with the yes. There were other reasons out there, but we can talk about the market itself. So what's been happening here is that the sterling has lost over 250 pips. It gapped down. It gapped down when it opened on Sunday night by around 150 pips. And if you're going to ask me now, what do you do with the sterling? Do you think it's going to go below 160, 161? I still think that the best currencies against which to sell the British pound are the Canadian dollar, and then afterward it will be the Japanese yen.
Okay, so if Scotland does leave, you talked about the oil, and that they have a lot of the oil. I mean, there are other places though that they can get the oil from. Oil prices have been coming down a little bit.
Right.
Just talk about that that relationship and
Yeah.
why it affects the pound so much.
Well, yeah, this is the first thing. I mean, because the majority of the oil of the North Sea oil, the majority, all of the North Sea oil and gas that the UK produces right now is geographically located in Scotland. So basically, if Scotland votes to go independent, that oil will be theirs, and it will not be the United Kingdom's. So this is one thing, and. Now, you made a good point. You said, well, oil prices are going down, and what England or what the UK, the new UK, would be losing would not be so much, because not only the prices of oil are going down, but also the production from that North Sea oil has diminished. But there is an important thing. There's a very important other thing, which is the nuclear warheads that are owned by the UK. They are geographically located in this country called Scotland. So the Scots are very, very anti-nuke. So what they're going to do, they're going to say, if we are going to get our independence, we're going to shut that thing down. We're going to shut it down. And that country called the UK, which is a big part of the United Nations Security Council, which is a big part of the NATO. Actually, it was England, the UK that started NATO, technically will no longer be a nuclear power. So imagine that. That's why the UK really, really does not want Scotland to go independent. If Scotland goes independent, and it will shut down this nuclear warheads, then England will have to wait for another 10 billion. Will have to wait for another 10 years. It will have to rebuild its own nuclear capabilities, God knows where, and it will take another 10 years, and it will cost probably 30 to $40 billion. So there's a lot of question marks there. The other third major question mark, so the first one is oil, not so major. The second one, the big one, is the nuclear. The third one is what would happen to Parliament and the voting system? What happened to the current Conservative Party in the UK when there's going to be this reject? There might be some big major earthquake going on in the majority. You know, the Conservative may lose, the Labour Party will take over, and then the Labour Party will. We can go into all these details, but this stuff is going to create a lot of question marks. There's a fourth point, which is, guess what? And this may sound funny or weird to some listeners in this early morning in the United States as they're having coffee. But guess what? This Alex Salmond guy, the head of the union group, is saying, you know what? If we go independent, we are not going to repay Scotland's share of the UK debt. You know, because we're going to be independent. Well, why should we pay? So if he will insist that it will not pay that, then probably then England or the Scotland-less UK will have to cough up, you know, that money. So there's a lot of question marks. But if there's one certainty, is that people don't like uncertainty, and the volatility on the British pound. It's like the VIX for the pound. You know, we know the VIX for
Correct.
the S&P. It's like the VIX for the pound. It surged. Last week it showed one of its biggest day gains since October 2008, and we all know what happened in 2008. So basically, so the vote is September 18th. It's a Thursday. It's one day after the Wednesday Federal Reserve meeting, and it's a very important week. And basically what will happen is that people are increasingly selling the pounds, and if there is any rebound in the British pound, they're continuously selling the pound. But the interesting thing is that the fundamentals of the UK are strong, and the fundamentals are good. And the pound has been going well, has been rising. And then as this reality hit home, and this fear, or call it the panic ahead of the referendum, is causing a lot of question marks, and there's a lot of selling of those long positions.
Yeah, I mean, another thing you mentioned there, and it's kind of concerning, is, you know, where the United States fits in this. I mean, with all the international turmoil that's, you know, going on, supposed ceasefire between Ukraine, what you have going on in Israel and whatnot. I mean, a lot of those nukes are probably very strategic for the United States. I mean, so this could have more than just implications on the United Kingdom. This could have worldwide implications.
Absolutely. I mean, you know, in the United States, it keeps it no secret that it very much wants Scotland to be part of the Union, and the nuclear warheads to remain there. One thing that people are saying, are probably saying that, because you see what happens is that it has happened before that a country uses its naval base at another sovereign country. It happened, but it never happened in the case of nuclear. It was like naval base, ships, this and that, but not nukes. Okay, so this is a new thing. One thing what we could see probably would the Scots would reach a deal, and they would say, okay, guys, you know, you want to keep your nuclear warheads, yes, but you have to pay us, and that money will actually dwarf whatever earnings they get from oil. That it could be an assumption. The geopolitical concerns that you mentioned are correct. You're right, especially what's going on with the Ukraine and so on, and NATO and the US want something, around the UK to be centered there, some sort of source of defense mechanism. That is true. There's a lot of other questions out there, but definitely what really we learned from this market is that 3 months ago, 2 months ago, 1 month ago, everybody was complacent. No way Scotland will get the referendum, and now there's a very good chance that it could actually happen. And if it will happen, it will not materialize until late 2015. So there will be even a bigger mess ahead of the elections in the UK in May. and there will be a lot of other changes. But what's been happening is that the sterling has been sold feverishly against major currencies, but mostly against the Canadian and against the Aussie, and it has fallen by almost 3%, 4%, and that's a lot in the currency market, and that's where the trades are. The other thing that you mentioned at the beginning of the program, yes, the European Central Bank, we had a big bazooka, big all-out action by the ECB on Thursday, deeper into negative interest rates. And selling the euro against the dollar, against the Aussie, that's what's been happening. And I like also selling the euro against the yen on the rebounds. So that is something very, very interesting to be seen.
Okay, and just switching gears, coming back over the pond here. Back in 2007, you were a little bit ahead of the Fed, predicting Federal Reserve rate cuts in the summer of 2007, actually 4 months before they occurred. I just wanted to get your take here on the current pace of tapering. Is it going to continue? Are they going to pull back from it a little bit? Mixed signs out of the economy. What do American investors have to look at in the short term and long term for U.S. interest rates?
Yeah, I mean, tapering, removing the QE3 does not mean tightening. The Federal Reserve has told us that tapering does not mean tightening. Now, tapering is going to be all complete, most likely in October. And after that, I don't think it means tightening because the Federal Reserve will still be reinvesting the proceeds of the bonds that it bought, and it's going to reinvest them in the market. So that is a form of kind of re-stimulating the bond market, providing some liquidity in the market. And the interesting thing here is that what concerns me here in the U.S. market is really this divergence between the falling bond yields and rising stocks. And usually they both, bond yields usually you have gone in tandem with stocks. So why are bond yields not really rising properly or not rising enough? Are they pricing a negative or a positive thing? Are they saying that growth will not be big enough, good enough, or are they pricing that there's going to be some disinflationary concern? Or are they pricing that growth will be weak, that when the Federal Reserve kind of no longer puts in those purchases, it is maybe creating some sort of disinflationary tendencies, which is keeping bond yields low, and growth will not be strong enough, which will eventually lead to a fall in the stock market. So that is the question. I think as far as the U.S. dollar, it does. You see, a few months ago, 6 months ago, 5 months ago, the U.S. dollar used to go up against some currencies because it was the least ugly of the currencies. But now there is more going for the U.S. dollar than just being the least bad. Very good. I think a good pairs to trade or to buy the U.S. dollar would be against the New Zealand dollar. They have some issues there, falling commodity prices, falling dairy prices. The RBNZ, the Reserve Bank of New Zealand, is going to stand pat after having raised rates. Buying the U.S. dollar, a very good trade on HFT FOREX with Hamzei Analytics, which I have a service for. We give some trades there, and our first trade was long dollar Swiss. And that trade gave us more than 80 pips. So the long dollar, sell Swiss, that is still a favorite trade of ours because the Swiss are having a problem with almost disinflation. And most importantly, this may be a bit technical for those who are just testing, their feet in the currency world. But basically, the Swiss National Bank now is suffering from a fear of having their currency rising too much or escalate or becoming so strong. So they may have to be forced to sell the currency against the euro because the euro is falling against everything, including against Swiss franc. So the Swiss National Bank, it may be expected to remind the market that it wants a cheap Swiss franc. So it may do that by probably intervening or jawboning. And if it does that, you will see a broad decline or further broad declines in the Swiss franc against the U.S. dollar. And that's why it is sometimes for those people who are afraid of selling the euro versus the dollar anymore because they're afraid of getting caught in a short squeeze, they could see long dollar Swiss and long Aussie Swiss.
And just one other question here. And I'm not sure what these implications are going to have on the gold market. Do you do an analysis of the gold market? Because I know they're not
Would
directly tied to the
mhm,
currencies, but do you
mhm,
have any
mhm.
take on the gold market here?
Well, look, there is this relationship. I actually mentioned it in my book, Currency Trading and Intermarket Analysis, which came out in early 2008. And basically, there was a very identifiable relationship between some currencies and between equities. So, for instance, when the stock market would go up, the dollar would go down, the euro would go up, the commodity currencies would go up along with stocks. Now, there's a little bit of a divergence. When I would look at the equity market, at equity indices, something that I used to look a lot. When you look at the use of margin debt at the New York Stock Exchange, when you look at other things that I mentioned, which is the relationship between gold and oil, well, guess what? Uh, I see that there may be a decline of probably 3 to 4% in equities, but I don't see anything near the more than 7 or 10% declines yet. The explanation, well, via technicals, I think the market may still have a little bit of steam left. I think if you look at the difference between the Dow transportation index and the Dow itself, they're still both talking the same language. There is no divergence. They're still looking up. And as far as the fundamentals, for those who want to link the effect of a strong dollar, and whether it will be spooking U.S. Equity, earnings. No, I don't think the dollar has risen by that much for that long in order for it to become an issue at the next earning season. So if you're an investor listening to this little chat here and you want to get something out of it, basically, the dollar is right now is a good alternative to it's a good alternative. It's probably the dollar and the Australian dollar are a major alternative, major currencies to stay in. If you want to venture abroad, I think, yeah, maybe the Canadian is still holding well. There was a big assumption at the beginning of the year that Canada was going to see its currency weaken because its real estate market was overstretched, but but the fundamentals in the job markets and internal demand they're coming out quite robustly. So the Canadian dollar is doing well despite falling oil prices.
Okay, all right. Well, thank you very much for that analysis. Coming on the show, giving us a good look at the foreign currency markets, and we'd like to have you back on again.
We'll be happy to. Thanks, Joel.